Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and with me joining in a very, very special guest, Mr. Vijay Chandok joins in. He's the MD and CEO at ICICI Securities. Welcome, sir, and thank you so much for speaking to us on Business Today TV. Well, first up, the outlook on the Indian equities. So far, if you see the year 2023 as it has started on a very volatile note, but for FY24, we did see some sparks in the equities. Do you really believe we would be able to climb all walls of worries as far as the economic uncertainties and slowdown concerns are there?
I think the last year has been a tough year for the equities business, and as we've entered this year, I think a lot of the tough spaces are probably at its kind of behind us. Whether it's inflation, whether it's interest rate, I think things have peaked. Valuations have corrected quite a bit. When you look at equity valuations, the overall valuations are in the ballpark of about 16, which is at the lower end of the spectrum over long term. So I think valuations are in a better space. The macros are looking better today. The difficult periods are sort of peaking. So as we look forward, I think there's a case for Indian equities to actually start outperforming sometime during the course of this year.
Okay. Will they continue to outperform the world as well?
I believe so. Because of the same factors that I just mentioned. The question really is that when is that going to happen? It doesn't look like it's happening right now, here and now. Okay. But I think the formation of the underlying characteristics are, to my mind, promising.
Okay. What about the sectors and the themes that you're betting on for FY24, sir?
So domestic facing sectors are something that we are very positive on. Banks, I think, will continue to do well. They've done well. Apart from that, some of the infrastructure sort of spaces, utilities, power utilities, cement, again, undertone of spending, government spending is pretty good. So all that should benefit these sectors. Pharma, that's another sector we thought would be interesting because it's been underperforming for a long time. It's well positioned to take off from here. So largely domestic facing, these are some of the areas that we are more positive on than the others.
How have you judged so far? The earnings season has begun. We've seen some of the IT companies reporting some dismal earnings, one okay earning and one good earning so far. The banks have started to report their earnings as well. What are you making of the earnings season so far and what's your outlook?
Over the last, I would say, year and a half, Nifty as a composite has managed its earning trajectory pretty well. But within that, there's been a churn, right? So I think that's what is happening just now. Banks continue to do extremely well and add to the Nifty heft. IT are going through a current, I would say, some kind of a slowdown, and that's what is getting reflected in a kind of a churn within the Nifty heavyweights. Consumers are doing all right. So consumers, banks, I think these are supporting. IT is currently weak. I think going forward in the immediate term, let's say this year, IT continues to look a little weak for probably most part of this year. Given the global environment, banks should support some of the other areas. I think consumers should support some of the infra sectors being part of the Nifty. Those folks should support as well.
What is your outlook on the mid cap and the small caps as well? I mean, they have largely been an underperformer. Will they finally turn out to be an outperformer this year?
You know, typically we've seen that it's first the large players which lead the pack. We are yet to see that happen in a meaningful way. Assuming that given where the underlying parameters are, sometime during the course of this year, if we start seeing that kind of a run-up in the larger cap, invariably mid-cap and smaller cap would follow. So it's still a way off, but in terms of sequence, it's going to be first the larger caps and then mid-caps thereafter. So some more time for us to wait for that to happen.
Since you're from the broking sector as well, what are the key trends that one can watch out for in this sector?
Well, I would just like to clarify, broking is one of the businesses that we do, but otherwise you should think of us more like a wealth tech player. So your question really is that the outlook specifically for the broking industry. Broking industry has got a few components. The F&O component, which is the larger part in terms of volume, has been doing extremely well. Even last year, despite difficult market conditions, the YOY growth was about 110% in volumes. So players who are dependent on F&O in a big way would continue to be all right. They would continue to show growth. Cash has been on a downward spiral. The delivery volumes has been on a downward spiral. It's down about 29% on a YY basis last year. That continues to remain still, I would say, tepid, weak. So players who are dependent on cash would have a mixed bag performance because FNO is doing well and growing. Cash is weak. The good thing is I'm seeing that cash is probably flattening rather than falling. Last year it was falling on a YY basis. This year, given that the base effect is kicking in, probably it's a little more flattish. So on a YY basis, things should be all right. Derivatives continue to show a positive trend even now.
Since you talked about wealth tech as a larger player as well that you are in, what are the kind of sectors that you can actually look at as key growth drivers for you going forward from here?
Yeah, so for us, we've identified clearly 4 growth drivers. One is the wealth business itself. That's number one. Number two, we've recently entered into loans distribution, and that's literally a majorly underpenetrated area. We are seeing good growth on our platform, and I think even within the economy, the country, there is good growth on the loans side of the business. So that will be a second growth driver. Insurance as a third growth driver. Particularly insurance as a solution, either for risk management or from a retirement planning or from a health protection or from an asset protection. I think there is a great underpenetration and demand for that. So that will be the third growth driver. And the fourth one is FNO, which is derivatives, which continues to be growth business. So we see growth specifically for us coming from these 4 areas. I think we are reasonably strong on some of the other areas, cash equity, for example, ETFs, distribution of fixed income. In most of these areas, we have a double-digit kind of a market share. So our endeavor would be to remain roundabout fixed and continue to show some improvement there, but big growth from those areas that I spoke about.
So what is the current revenue mix between these 4 categories, and what would you see it as evolving going forward?
So historically, you would have found that equities would have dominated our total mix of revenue. Few years back, for instance, it would have been closer to 60-65% revenue coming from equities. This number, if you look at in the more recent times, is down to less than 40%. So the mix is clearly shifting in favor of non-equity products. So more than 60% is actually coming from various other types of wealth tech products. In the next, let's say 3 years or so, our endeavor would be to have at least 3 or 4, or I would say 4 or 5 thick line items, broadly equal in size, as opposed to having one thick line item, which is the traditional line item of equities, dominating our revenue mix, and broadly have an equal distribution between these 4 or 5. So I don't want ideally anything to be more than 35% on the outer limit, ideally 30 to 35%, and the other major ones to be not less than 20% of the mix. So that's the attempt we are doing and the direction in which we are pushing the company.
So if you could share the growth outlook for FY24 for yourself and the company?
So we are not giving any specific growth guidance, but having said that, I think our effort would be continue to hold your position and improve in areas where you're already strong. The areas where we are underpenetrated and the growth is good, and specifically I mentioned those 4 areas, we would want to redouble our efforts and try and see clear, sort of a higher growth than the market in these specifically 4 areas. So clearly, I would hope that given a relatively tepid base, as well as growth from some of the areas which constituted a much smaller proportion in our last year's revenue base. If we are able to execute well and the market is not going to deteriorate from here, and chances of that are reasonable, I think we should start showing some reasonable growth over last year.
All right. Well, many thanks speaking to us on Business Today TV, Mr. Chandok. Always a pleasure having you with us on BTTV.
Thank you so much.